Hello, good morning. It's Tuesday the 8th. I'm FX Plu, and this is the market brief. So, if you cast your mind back, even just a couple of weeks before Russia invaded Ukraine, the UK economy looked likely to slow down as the Bank of England rate hikes got to grips with inflation. Since Russian troops crossed the border into Ukraine, everything changed. We now have widespread fears of a global recession fueled by rising energy prices, and discussions continue over a ban on purchasing Russian oil and gas. Boris was on yesterday. He outlined how he believed the UK should continue to buy Russian oil and gas due to the lack of alternatives. While it's difficult to reconcile the war in Ukraine with the G7 continuing to trade with Russia, it does rather demonstrate the utter reliance the West has on energy-producing nations. Efforts to isolate Russia via sanctions are all well and good, but they take time. A bit of time before they really bite. So with so much money still entering the country via trade, Russia's holding firm for now. But what about the energy suppliers? If the base prices continue to go up and up, then even with the higher price caps from April, all those higher household bills that the inflationary headlines focus on won't be the point. The suppliers will likely to be locked into a loss-making price structure. So is it right to cap the consumer costs? Yes, it helps prevent profiteering. But what about when it puts the suppliers at risk? It might be time to consider switching your energy to one of the big boys. Safety first, right? Meanwhile, inflation is expected to reach 7.5% next month, and it's getting harder to see how the UK will avoid a recession. Worse than a recession, the term stagflation has been bandied around a lot recently. That's when a country has high inflation and low or negative growth. While it's been mostly mentioned in conjunction with the Eurozone, it's now much more of a concern for the UK economy as well. There may be trouble ahead. In the market, sterling continued the relentless slide towards 130 against the dollar. Yesterday we bottomed out around 131, and that's where we opened this morning, and we kick off around 120.75 against the euro. So over in the US, the energy outlook is slightly more self-sufficient, so economic focus remains on inflation and the Fed's rate tightening cycle, which is likely to start next week. The market is still speculating over whether the Fed will start with 25 or 50 basis points as the rate hike. There are perfectly acceptable reasons for both outcomes, but a 25 basis point hike will probably disappoint the market and be considered a rather weak response to rising inflation. Unlikely to see a dramatic currency reaction though, as safe haven flow is propping up the dollar. Biden's been on. He looks prepared to go it alone by banning the imports from Russia. As I mentioned earlier, the US energy outlook is much more self-sufficient, and they are not nearly as dependent on Russian energy as Europe is. So that decision is made much easier for the US to enact without the same level of economic fallout. Oil went over 120 a barrel yesterday, and wholesale prices have doubled in the past 3 days. The market is calling oil up to 150, but the deeper question is, how long will the prices remain high? And that question, the answer there, of course, lies with Ukraine. The dollar index continues to benefit from safe haven flow. Yesterday we saw 99.41 as euro dollar dropped to 108.20. It's staggering how little support there is for the euro right now. Right, well, that's it from me. Have a great day. Do join me again tomorrow.
If you do not have a clue, then just tweet through and ask FX Blue.